Welcome to the Whack Attack Podcast. We have another episode for you guys here today. We're here with Clifton Larson Allen. They are the 8th largest accounting firm in the United States. We have Matt Winans, who is our accountant here at Three Ventures, and Patrick Smith. Patrick, tell us a little bit about yourself.
Well, thanks for having us here. Patrick Smith, I'm the managing principal for the technology industry group for the firm nationally. Started my career actually in the Bay Area. Spent 14 years with a couple of big four firms, about 11 years with BDO, and recently joined CLA back in 2017. Spent my entire career working with technology companies, startups through public companies. So I had a lot of experience working with these organizazations, and looking forward to this discussion.
Absolutely.
We're happy to have you here. That was fantastic.
And you flew down from Seattle, yeah?
I did.
Yeah, thank you very much for coming down to the studios in Northern California. I'm glad Matt got you over here. Matt, you want to tell us a little bit about yourself?
Yeah, Matt Winans. I'm a tax principal at our Roseville office here in sunny California. Been practicing roughly 17 years. Started my career in San Jose, similar to Patrick, and relocated up here a few years ago. My favorite story I like to tell is my kind of Cinderella story of starting with a bootstrap seed company, tiny company, maybe $500,000 in cap, and they just exited 2 years ago for $300 million to a public company. So it's
excellent,
start to finish.
This is like a virtual fist bump across the table here.
Yeah. Patrick, we're going to be talking about some advice here today. So I'm sure, like most good pieces of advice that you're not paying for, you're not on the contract for, there's going to be some disclaimers. So do we have any of those to go over today?
Yeah, just one. Before we get too far down the path, we need to say as a quick disclaimer that our comments here today are intended as general information and don't constitute any financial, accounting, or legal advice.
Okay. Excellent.
It's good for
We've
everyone
been
to know.
lawyered. CLA,
Yes.
you've been covered.
Yeah.
We've seen, yes.
Matt and Patrick, we are good to go. Okay, so if we are founders of a startup, obviously, and we want to go and try to get some VC money or some seed money, VC money is hard to get right now. Obviously, we're not necessarily in the most ideal market conditions. From an accounting perspective, what should we be considering as a founder if we're looking to do this?
Yeah, well, I think when it comes down to raising money, just in general, whether it's the team or the product, it comes down to credibility. And one of the things you really don't want to have happen is that your accounting or your financials or your forecasts will stand in the weight of that credibility. So it's really important to have those things dialed when it comes to coming to ask for people for money. If you can't get your accounting right, what else are they missing?
Right, because this is the back end of running a business. And if you're not organized on the back end, that says a lot about the way your business operates.
Yeah, absolutely. And, just modeling, knowing your KPIs, understanding the uses of the funds, what is it you're trying to do with the money that you're getting. And that just all goes toward, building that story, that credibility that allows you to, do the mission that you've tried to do with your startup.
And we talked about this earlier, Matt. You went from seed round to 300 million, exit to a public company. At least my experience and the people I know, it's easy to get money from people who you've already made money for. So with that said, from a perspective of accounting, how important is it to not just have your accounting right, but always make sure that you're taking care of getting that insight to the people who are providing you with funds?
I think having an open relationship with your financial advisors in all aspects is the most important thing. Having regular calls. I've always prided myself as not charging by the 6-minute interval like an attorney does per se, mostly to facilitate that open line of communication. The goal being able to update your clients regularly with immediate information, especially over the last couple of years with all the tax law changes. Mm-hmm. It's been a very dynamic environment that's changing constantly. Case in point, just last week, the IRS came out and put the stop on all processing all ERC claims. Right?
That's the employee retention credits?
Yep.
Yeah.
Correct.
Yeah. And so getting into that, how would you sort of categorize the do's and don'ts for founders, if they are looking to get in front of an investor and pitch them?
I'd say having your ducks in a row right from the start, clean financials, reconciliations done, sharp cap table. I'd say that's the most common thing we see that kind of gets passed on.
Yeah, I mean, a lot of times you'll see the shoebox accounting, everything on a spreadsheet. It just doesn't really fly with folks who are writing checks. Accrual. This isn't sexy, but accrual accounting is important. The accrual accounting exists because it does match revenue and expenses and period costs and so forth. Cash is king. Everybody's worried about their burn rate and how much money do we have, and that's also very important. You have to have both of those things. But from a management perspective, accrual accounting is key. And you can always, from a tax perspective, do cash, but being able to effectively talk about the business, where the money is going, and the value that the investors are going to get out of it, and also raising at the right time. You don't want to be too high of a valuation and try to maybe give away too much of the company too early. So those are the things I think that you would want to make sure you're thinking about.
That makes a lot of sense. Go ahead, Curtis.
Do you want to just give your experience and insight on timing?
In terms of
raising
funds. So I think a lot of founders think they need to raise as much as they possibly can. And a lot of them also will maybe take the first money that's offered. I really think it's important to make sure that you need to be as diligent about who you're raising money from as much as they're worried about giving you money, because that's going to be a relationship going forward. And then from a timing perspective, it's also okay. What's the valuation that everyone always thinks their valuation's higher than it is. But if you go out too high too soon and you get more money than you need, you may be giving away too much of the business too early. Yeah. So it's just that's where you've got to really kind of think about, maybe it isn't, maybe you don't need 10, maybe you need 5, maybe you need
manageable chunks.
Yeah.
And
that'll where you can get the bounce where the 2 or the 5 is going to get you to 20 versus a 10 might get you to 15 kind of thing. So you want to think about that.
Yeah, it's a little thinking ahead too, because I feel like one of the things that you want to do as an entrepreneur, especially if you're raising money, is realize whatever money you do take, that you obviously want to get to that next milestone with, because you're trying to increase valuation. I think startups are really focused on sort of IP and where their opportunity really exists in the market as I call it sort of a subjective valuation, right? Depending on who's writing the check. But from that perspective, if you are talking about quote unquote shoebox accounting and making sure you have your ducks in a row, and then also setting yourself up to where you can get to that next milestone, from an accounting perspective, if we're starting at say like a seed round, mm-hmm. What is the difference that you guys are sort of expecting or would advise a startup to have at a seed round versus like a Series A or a Series B, if they're trying to get to those next milestones? Because I think this is a good topic depending on where you're at. From my perspective, like a seed round, as soon as you have enough money to pay a proper professional to do accounting, you should do that. Having reports that look proper and that can be read and that can be understood by investors, I think that's important. Usually in the seed round, it's all expenses, right? It isn't a heavy lift, right? Because all you're doing is spending money, right? When you get to that, Series A, and now you're hiring employees and likely having revenue, that life gets a little more complicated. And then you really want to have that good foundation that you had at seed and build on that as you grow. Nice. And if you guys are, say, helping out with providing financials to these investors or to some VCs, what are some of the common issues you are having to deal with so that we can help anybody who's in this state start to get into that mindset of, these are some of the things that I'm going to be coming up against, and what should I prepare myself for from a hurdle perspective with this accounting?
I think sales tax and tracking sales tax as you grow into that revenue model is a big sticking point. That's one I commonly see. Having the cap table hammered down, especially with stock options, making sure that's tight. If you go into that Series A and that's not tight, you're going to have to figure it out anyways in diligence. So you might as well have it so you're looking a little bit better when you go to raise that fund.
Right. And can you explain a cap table to somebody who doesn't know what that is?
Yes. So a cap table is the ownership of the company, right? And so you may start at being a founder, a co-founder, a couple co-founders. And as you go through the process and you onboard folks or you bring people into your project, you decide, hey, I want to give these people a little bit of equity in the business as an incentive, or maybe it's to mitigate cash flow or some combination thereof, that they become owners, and that's part of that cap table process. And so we commonly see, like with a seed round, people tend to do a little bit more of that shoebox approach. And then as you start to develop, I'd say, critical mass and momentum, it needs to get tightened up, particularly before a big funding event, because what ends up happening is if you have, let's say, a software engineer that you didn't make an owner and you weren't really sure where the company was going to go, and now all of a sudden you have a real offer on the table to fund it. Well, that offer is now pegged the value of what that company is per share, right?
Mm-hmm.
Whether it's 5% or 10%. And so now to get ownership into that software engineer and say, hey, we're going to make you whole and bring you into the ownership circle, that's an equitable, that's an income event, a taxable income event for that owner. And that's a painful situation to be in.
And he gets it at a higher rate, not the lower rate.
He gets, it's ordinary income. It's non-cash, right? So now you've got to pick up $100,000 of income and pay tax on it, but there's no cash.
Yep.
So it's a bad answer for everybody involved. And this might be a good point to kind of pivot back to like entity type when it comes to structuring a business and how to pick what entity type, because there's LLCs, there's C Corp, there's S Corp, partnerships. So there's a lot of different choices out there when you're starting a company.
Mm-hmm.
And having that right entity choice can really impact how you can raise money.
Expand upon that.
So in the startup space, in technology, I think the go-to entity is a C Corp. There's a lot of reasons for it. One, there's this concept of qualified small business stock, which gives you a really preferential treatment if you hold it long enough. Professional money understands C Corp. They understand what preferred stock is. They understand equity compensation structures. There's no ambiguity as to kind of how these things are structured. They're all pretty much the same. So when I'm writing a check, if I'm an investor, I know my preferred stock is going to have this treatment, and there's going to be common stock, and then there's going to be a carve out for your option pool. A lot of startups like to pick an LLC taxed as a partnership because it's easy. You can do it online. You can do it yourself.
Please don't use LegalZoom.
They also start as a sole proprietor usually, and that's the first legal step, right?
Yeah, I mean, so what ends up happening is, and there's usually no documentation, there's no understanding of the agreement, and you can end up giving LLC units to one of your engineers, and no one really knows what that means, and there's a lot of complexity around partnerships and LLCs, and that's why investors don't love that structure, because they're very flexible. If you need flexibility, they're great. If you're running a lifestyle business, if you know what I mean.
Yep.
Where you're just
Yes, we do.
turning out cash and you're going to go buy your boats and your cars and you're just having a good life, versus building enterprise value by reinvesting any of the funds back into the business. LLCs are great for lifestyle businesses because you can suck all the cash out. C Corps in the tech space are going to be really good for kind of reinvesting that money, growing that enterprise value, because that's going to be the best thing for the VC and the investors going forward. So understanding kind of what entity you want and what do you want to be when you grow up, right? What's your exit?
What's your exit plan?
What's your exit plan?
So we had a really good episode called Running a Business with Family and Friends. It was Curtis and Wally and I on it, and it was about our experience, largely going through having to, make sure our books are all in order and everything else, because we have a couple, we have LLCs and a C Corp and some other items, and
accounting, legal, and financial growing up.
Right. And what really sort of comes to mind is when you guys talk about that shoebox accounting approach, really, I think from the start, if you have an idea or something you want to execute on, you should be just as diligent with your corporate structure, with your accounting, as you are with being passionate about the product or service that you're trying to offer. Because fundamentally speaking, it seems like it would be most advantageous to allowing you to pivot or move quickly if you do meet that right person who believes in you or believes in the area of opportunity that you're currently trying to get into. If you just had all this right in line, like imagine if you had it in a package, it was literally just a zip file, you downloaded it, NDA signed, boom, shoot it over to them.
Have a nice day. Thanks for playing.
Now, do you guys ever see that, or do you guys have some type of framework that you sort of can recommend that helps package that up?
I work with a lot of attorneys that get it, right? That's the thing that, and they know I get it. So we work well together. So when they're working with our startups and they're putting the package together, they get it. We don't do legal work as accountants. We can suggest structures, but the actual legal structuring is done by the law firms. So we regularly partner with law firms and make sure our clients are structured properly.
Yeah. So somebody who is let's just say starting up this idea out of their garage or mom and dad's basement or whatever have you, and they obviously don't have access to those types of resources. Any types of tips or recommendations on trying to do your best to keep things current until you can afford to work with a CPA or an attorney?
I'd say the first thing is get at least a dedicated credit card and just track things as bifurcated as you can and silo it to the best extent you can while you're kind of getting it moving. Circling back to
and bank account
credit
card and bank, just keep that separate.
And circling back to your comment about keeping things clean and tidy and quick, a nice little war story I have is I had a client that was just happened to fall into potentially raising some funds. The challenge was they had a cap table with an employee who had exited. They didn't know where he was. They couldn't find him. And they needed to get him to help with the due diligence to at least agree to the next round of funding. And he was nowhere to be found. So it kind of held up the deal.
Yeah, I mean, that's actually another good example of where the entity selection, the type of stock you're issuing, because if it was a non-voting stock, this probably wouldn't have been a problem.
Since it was,
then it was, and now it's a problem. The other areas that I see being really kind of gnarly are what I would refer to as a post-it note cap table, where you've we'll get you the stock, we'll get you the equity, and it's sort of been kind of a memo item, but it's never did the deal, never issued the stock, but there's a promise out there in an email.
Yes, there's written proof, but there's not actual corporate proof in the books. And I think this is one of the big realizations in just talking with a variety of people and businesses, and you actually have to run the corporation the way the corporation's meant to be run, and what you get is like a staple item from LegalZoom or something doesn't come with how you're supposed to run everything. Correct. And that's the biggest thing. I mean, you guys said like a credit card and a bank account. Then like that's from an accounting perspective. From a legal perspective, working with someone to say, what is the minimum obligations that I need to meet as an owner of a corporation with my other owners, board of directors? What does the state that I'm incorporated in require me to do? So that way you actually have an organization that's functioning by the law.
Yeah. That's so key. The other thing that you want to think about too, from a equity comp perspective, when you've got this corp and you're trying to raise money and you've got, an equity comp structure that you've issued restricted stock. Well, there's this concept called 83B. There's an option when you receive restricted stock. Basically, it's, okay, I'm going to give you 100 shares, and then they're going to vest over 4 years, okay? The value of those shares today is probably close to zero. You're a startup company, you have, you just raised a little bit of money, but it's, it's basically going to be par value stock, right? Well, you have the option of saying, and there's no taxable event because it's restricted. The taxable event occurs as these restrictions lapse over time. So over time, the value of the company could go up. So let's say in year one, the value was $1. In year two, it was $3. In year three, it was $5. It's $2 a year. Well, when those restrictions lapse, you have to pick up non-cash income for receiving that stock of that value. Do that every year. And now you, as the shareholder are on the hook for paying that tax. Well, Section 83B allows you to say, yes, I've received restricted stock, but I'm going to elect to take into income the value of that stock today. So if the value is close to zero, no harm, no foul, right? You say, okay, even though it's restricted, I'm going to pretend that I received the stock and I received all the income from it. And at that point, the income is zero. So as this stock vests over the next 4 years, nothing happens. The tax event has already occurred on the date you received that stock.
Because you've already basically, in quotes, assumed ownership.
Correct.
Yeah.
And taken into income any of if it was worth $1 and you got 100 shares, okay, you got $100 income. Have a nice day. But what can happen is they either fail to file the 83B because it has to be filed within 30 days of the grant, or they either fail to do it or something happens where it didn't get registered with the IRS, and then 5 years later, it's all vested. First of all, you haven't really taken all the income in when you're supposed to, so you've got that exposure.
Amendments. Yep.
And now you exit, all of that income is ordinary.
Oh, wow. Not long-term.
Not
investment
long-term
income.
capital gain.
Because you didn't start your clock.
100%. So, yeah, bad answer. And there's no, believe this is something I've been dealing with a lot recently, is either bad 83B elections made. I had a client who, poor guy, he packaged it up, he put it in the mail. There's a mailbox rule that says if the U.S. Postal Service stamps an election of a tax election, that's the date you've made the election. He gave it to the post office. They failed to stamp it. It got lost in the mail. It was returned to him like 2 months later. There's no stamp on it. There's no nothing. I mean, we can't even hang our hat on the mailbox rule. And his 83B election didn't get made. I mean, he did all the stuff.
So he could do it again for the next year. So you want to start his clock as quickly as possible for the next year.
Well, no, because it's a 30-day. You can't. There's nothing to do.
Okay. It's not presented like the yearly. It's like you got to get it straight away. Otherwise, by the time it does come due, then you're subject to that taxable event.
And I would say the worst part is most startups are never going to amount to anything. So we've always called stock options
rough
toilet paper. So
toilet paper stock.
You're gonna basically pay taxes on something that's I would say 90+% of the time worth nothing.
Yep.
And so it's definitely advantageous to maybe send 3 copies in if you're going to use snail mail, and go with the first one that makes it there. So I'm totally on the same page.
I wanted to set something up here. So how could let's put a hypothetical scenario here. Let's say you're an employee startup. How can you make sure that your paperwork is filed within that 30-day window? Do you have to file it yourself or from the company? Like, let's maybe put a scenario out here to help people who might be in this situation.
Yeah. My advice on any mailings going forward is certified return receipt. Absolutely. I think especially with COVID, we've seen a decline in reliability in the USPS. And so I advise any of my clients, certified return receipt has to happen, even for filings themselves.
Yeah.
Most of the things we do today is digital, but if you have to paper file it, that's the way it should go.
Take it straight to the post office, get your receipt, deliver it yourself to them, pay for it on the
Selfie.
spot. Yeah,
selfie. Well, the other thing to if you're an employee of a startup and you're being offered options, have your accountant, get an accountant, hire somebody, come to a professional and say, here's the plan, here's the offer agreement. Is there anything I need to be thinking about? Mm-hmm. And the answer will be yes. Where's the 83B? Normally what will happen is those agreements have the 83B as part of the agreement. And if you're working for a company and they're offering you stock and that's not part of the package, then you need to raise that as an issue and tell them to go hire somebody to help them with their stuff and things, because that's should be standard op.
And on the flip side of that, as a business owner or a startup owner, you want to invest and protect your people. And what does this say when you miss a 30-day window by, one, not being disciplined enough to understand what the laws are, and two, by not giving your people the best protection when you offer them something. That says a hell of a lot about who's running the company.
Yeah. And I mean, to just put a exclamation on at the end of this, I had a transaction. They had the deal. The deal was done. It was, call it $10 million deal. They had one shareholder who didn't do the 83B and was going to get ordinary income treatment. And in order to get the deal done, they had to pony up. They had to basically cover the tax cost for this one guy. And so the economics of the deal had to change because of this issue.
Oh,
and it wasn't insignificant.
Wow. So I mean that's
well,
sort
yeah,
of,
ordinary income on $10 million. Do the math.
yeah, that gets to the point of the fact that you're playing in the professional arena, and so T's have to be crossed, I's have to be dotted, and at the end of the day, that's what it really comes down to. So we talked about a little bit earlier from the company side, reaching some milestones for the next rounds of valuations. When do you guys normally see a startup or somebody in a seed round start to get to the point where they are going to be working with a larger group inside a CLA or a larger group inside of an attorney's office to help them start to manage these issues at scale?
I would go with when you have significant revenue and employees. So
what is your
significant?
Thank you.
I don't know, $1 million ARR. But really it's going to be a function of employees and where they live and where your customers are.
Well, and it could also be capitalization, right? Because we've seen some fairly non-revenue generating companies that have a large cap because they've been bootstrapped. And so the kind of segueing a little bit here, I think the mentality shifted a little bit in the last 10 years where it used to be, hey, I have to go get outside funding, to maybe I'm going to bootstrap this thing myself, run it for a while and see where we goes. And I have several clients that have done that. They've exited large companies or what have you, and they just say, it's mine. It's 100% mine. I'm going to run it. And they have deep pockets to do it. And so they can hire the staff. They hire the engineers. They do it all themselves. They're not necessarily generating revenue, but they have enough sophistication and enough things going on that at that point it's time to start bringing in more than one professional and looking at things, and keep making sure corporate hygiene is proper.
Yeah, well, I think that gets back to the point you guys mentioned earlier about, not bringing in too much too fast, not giving away too much too early. That's sort of the whole mentality of bootstrap. Bootstrap doesn't mean, self-funding it yourself until you're making money. It's self-funding it to minimize the amount of people you have to bring in initially, because at least this is my experience, the people who are brought in first usually get a higher percentage of the pie. People who are brought in later get a lesser percentage of the pie.
Your key hires for sure. And bootstrapping is just being disciplined. What do you really need at this point in time?
Right. And I think, Matt made a good point. And that was kind of, I think we were both saying the same thing, but coming at it from different perspectives, is when you have enough capital or money to hire 10, 12, 20 people, where those people live, where they're operating in the country, out of the country, multi-state, that's when things start getting complicated. So you can be a small company and have big company problems.
Stop talking to us about this. We know.
Do you have a plug in the back of our head? Could you expand on that, please?
Well, for example, especially in post-COVID, remote workers, basically wherever you have an employee, you have what's called nexus or a connection to a state. If those employees decide to work, outside the country in Singapore per se, you may have a what's called permanent establishment in a foreign country. So those sorts of things then now have to be evaluated.
I'm only laughing because when I went to Singapore, I came back and told Alan, I said, my wife and I could qualify to get a temporary residence over there. That's how much we liked it. Out of all the places, you're like Singapore.
But also, let's say you're based out of California and you go to Colorado and you have some people there. Well, in the Denver Tech Center, which is where we had some people, guess what we had to have? We had to have a foreign entity because we had payroll taxes. And then we had to pay the
City of
income privilege tax from the city of Greenwood Village.
Congratulations.
Right?
Economic, I think it was employment privilege tax.
Yeah, the employment privilege tax. This privilege, right? This was pre-2020. And the irony of that was the amount of like entity and legal structure we had to put in place multiplied by just having one person in Colorado. Like basically everything we had operating in California, we now had to multiply it to operate in Colorado. And then we had all these little nuances and accounting headaches and administrative headaches, healthcare. Like, so yeah, I feel the pain. I understand.
They do not make it easy for businesses to operate.
They don't.
And just in general. And kind of a personal situation. My wife runs an Airbnb in our house. We're in Washington, Seattle. Like the amount, like I'm a highly trained professional. The amount of work I had to do to get her B&O tax thing set up and file those taxes every quarter and do I don't know how people who don't have accounting backgrounds can operate.
Or they're not doing it correctly, and they're just doing
that.
They're just doing it to the best of their abilities.
Right.
And fingers
like
crossed.
I said, so that's just my point is that they don't make it easy.
Well, I think to touch on that a little bit, circling back to the big corporate problems, even if in your small company, is having that relationship with your service providers, right, and calling them ahead of time and saying, "Hey, I'm thinking about doing this. You've probably seen it before because you serve a bunch of clients like me. Do you have any suggestions?" Because case in point, we've had clients go out and set up foreign subsidiaries, and they don't realize the compliance that comes with a foreign subsidiary for having an employee there. It's pretty nasty.
That I'm so glad that you said that. This is one of the reasons we say like a legal triad, right? Legal, tax, and why am I drawing a blank on the
attorney, financial advisor, and CPA.
Financial advisor. Thank you. Being able to call people like you guys who you work with tons of various different clients and different businesses and just saying, this is what I'm looking to do. What do you recommend? That is worth all of the money you guys get paid for anybody who's running a business, because you get to avoid a critical misstep. It's going to come with sucking your time and your money on a critical misstep. And I think this conversation lends itself really nicely into what's been going on the last few years, which has been full-blown remote work and how that's affecting the tech sector. And then talking about hybrid work and maybe being, remote friendly in a state. So have you guys been advising any clients on those types of scenarios?
In so much as because really you don't ever really want the tax tail wagging the business dog, right?
True.
You really want to run your business effectively and efficiently, and if it's important to the employee base to have remote work, then you should probably have remote work. But then understand it comes with a cost and of time and money and effort. So when it comes to advising on that, that's kind of how I usually advise on things like that.
Sorry to interrupt there, but let's talk about the due diligence we've both been going through recently, because we have several clients exiting currently, and so we're both on due diligence calls with potential buyers, and typically in that process they have to flesh out all the problems, right? And so let's talk about employees in remote workforce. The things they look for are 1099 versus W-2 employees, and misrepresentation, right? If you're treating a 1099 employee as a W-2, then you probably have some exposure there, right?
And they're going to reduce the valuation based off of potential tax liability, based off potential penalty liability, and then litigation too as well.
Yeah, I mean, it'll go into the holdback or the escrow of the deal, right? They're going to add up all of the exposure items and say, okay, well, there's $1 million of tax exposure here, so we're going to, here's of your $10 million deal, here's 9, and then this $1 million is going to be held in escrow for 2 years or whatever.
Just in case something happens.
So let's talk about that a little bit. How, in that case, have they miscategorized a 1099 versus a W-2?
Well, it comes down to the employee versus independent contractor rules regarding control of work time, tools, products, things like that.
Location, doing your work, when you do your work.
Yeah, who does, how they do it.
And does the 1099 contractor have other clients?
Mm-hmm.
Actually, being in Washington and close to the Microsoft headquarters, they got nailed hard with the contractor versus employee, because they'd have employees that then would leave the company to pivot to contractors. Job stayed the same, and the IRS came in and said, "No, you can't. This isn't right. They're employees. They're acting as employees. They should be treated like employees." So when when a Microsoft employee leaves and they want a contract, they have to go through another firm, and then you have to have this list of things that they have, such as other customers, their own equipment. They can have control over their own schedule, that kind of stuff.
Yep. Now, varies by state by state.
No, it's pretty much a federal rule. Well, I guess
California's AB5.
Yeah. Yes.
Well,
you want to go down the Uber.
No.
So basically, if you don't tell them when to work, if you don't provide them with any equipment, and they have the ability or have had other clients, not necessarily they currently have them, they're generally a contractor.
They could be.
Yeah. I want to throw a stipulation to this, just from a tech perspective, not an accounting perspective. You can actually need to send somebody who would legally be considered a contractor hardware for them to do their job, because it may contain access to certain systems. Right. As long as their full job isn't solely working for that company and they have other clients.
Where it's a case by case. I mean, you have to look at each facts and circumstances around each employee, contractor, candidate.
Yep. Now, is it arguing your innocence in the case of you guys, since we're talking tax code, or is it more defending why you should remain innocent?
I think it's more just the buying an insurance policy for the purchaser.
Yes.
Right. That's really what it is, leaving the money in escrow. So it's
from that perspective.
Yeah.
The escrow piece. Yeah. I mean, that's essentially what it is, right? It's contingent exposures.
And there's usually indemnifications too on the seller side, saying I'll own it. If something comes down, if you're buying the company and it was my company, I'm indemnifying you from any obligations I generated.
Right. I can't transpose my problems onto you.
Yeah. Right. Yeah. Well, that's a really good point. Yeah, that's a unique slippery slope, right? Because there's this whole yin and the yang. We talked about the yin side being it's incredibly hard to even run the infrastructure, the operations, to having employees in multiple states. But then you're going to get penalized for having contractors. Like, for example, the issue with, say, wanting to hire somebody really good you find, but maybe they're in Arkansas, right? And they only have one person in Arkansas. Well, you're not going to set up shop in Arkansas, and then everything that comes along with that, benefits, retirement, all that other stuff, and foreign entity filings, et cetera. That's sort of why I think places like TriNet and other outsourced HR are so popular, because they handle and do all of that for you.
Yeah.
Do you guys see any issues with valuations if they are working with companies like TriNet or third-party HR solutions?
I wouldn't see. I haven't seen any negative impacts.
Yeah.
I mean, to me, it's just a good example of using another good third-party provider when it comes to managing the business.
From employee mobility, I would say one of the other things to be aware of is being remote is great. It's kind of a nice carrot to provide your employees, right? But they also need to notify you on what they're doing and where they're going if they're going to be working anywhere other than their home remote location. So if you hire somebody in Arkansas, and they traveled and they do an Airbnb for 3 months in Hawaii because it's COVID and the shutdown. Yeah. Well, now you've just generated potential filing obligations in Hawaii. Or if they travel to India for a month, like, a lot of engineers will travel to India and stay there for a month. Now you've created permanent establishment in India, and you may have an Indian issue as well.
Wow. Yeah, this is something that's really interesting. So now we're getting out of the accounting world and out of the legal world and into like the fractional HR services, talking about like employee handbooks or contractor handbooks or, company policies. And it's interesting because a lot of the stuff that you guys have just talked about, we have some policies internally, but we never would have been able to come across them if the lady who's running our operations and our HR hadn't managed Sports Authority's 125 stores in the East Coast and, Connecticut and that area. So yeah, we got a firsthand sort of establishment in that, and that's pretty wild. But pulling this back up to sort of the accounting side of things, multinational companies. There's some cases where you do have to be multinational. Say you want to service North America, or let's say you're in Canada and you want to sell in the United States. What are some considerations there that they need to pay attention to in terms of equity or transactions, et cetera?
You're going to have a few things right off the gate. You're going to have a potential local presence and a local filing obligation. So whether it's GST or Canadian, you may have a filing obligation there if you're selling in Canada. You're also going to have potential transfer pricing. So if you set up a foreign subsidiary in, say, Canada, and they're selling product, from the U.S. parent, well, Canada probably doesn't want you sucking all those profits back to the U.S. via some sort of management agreement or what have you. They want you to pay a little bit of tax in Canada because it was earned there, which is a reasonable expectation. And so there's what's called transfer pricing, where you establish what that margin should look like to recognize those profits in those local jurisdictions.
Nice.
And that's why there's a lot of the issues with Ireland right now with people moving their money through there.
Before the new international tax regime was put in place, Ireland was a very popular place to establish your foreign base of operations. There was 12.5% tax rate. And basically, if you kept all of your profits outside the U.S., you could, not pay U.S. tax on those profits until you repatriated them. The new international rules sort of kind of put a kibosh on those strategies.
Well, I'm glad I brought that up. Can you explain some of those rules?
Yeah, so basically, if you've got operations outside the U.S., but you don't have a lot of substance, you don't have a lot of people, you don't have a lot of equipment, it's really just sort of a strategy, a file box that then the IRS will make you pull those profits back into the U.S. It's called GILTI, which is,
Is that an acronym?
It is an acronym.
Okay.
If
Global
intangible taxable income.
Yeah.
So
Guilty.
Yeah.
Global intangible low tax income.
Yeah, low tax. There it is.
Yeah.
And I'm sure that that was designed to be ironic.
That is
or a little too on the nose.
Yeah.
Don't you think? And
Guilty.
Excellent. So basically, you end up having to pull that income back into the U.S. anyway, right? So there's no benefit or encouragement to keep it offshore. Which is the other thing that they changed was the corporate tax rate. So before 2017, the corporate tax rate was 35%. 35%.
Yeah, it was progressive graduated, but kicked up pretty quick.
The 2017 Act dropped the rate to 21%. So flat corporate rate.
Yeah,
right?
And the crazy thing that doesn't make any sense to me is you were sort of educated on global economic affairs, you would realize we should have just made it 12.5%. Because then not only every U.S. company would have came to the United States, every company in the world would have came to the United States.
Yep.
Yeah, that's Congress for you. So, but what it did do is close the gap, right? So these
Guilty people.
These structures, I refer to them as mobile income structures, where you can kind of move your money income to low tax jurisdictions. 12.5 to 35, 37. That's a pretty big delta.
It is.
You can do some hedging there and make some money doing that. 12.5 to 21%. The care and feeding of a large structure like that kind of eats into the benefit of keeping that money offshore.
It's little. Seems like it would be little gain for a lot of effort.
Correct. So I think that's what you're seeing now is that there's fewer of these opportunities. Most of my clients I'm seeing now there's a rule where if you've got an entity, let's say in Germany,
okay,
and there's transfer pricing, there's all this stuff. If it's a controlled foreign corporation, you can kind of keep it separate from the U.S. business. But for tax purposes, you can pretend like it's a branch. So you check the box and say, this is a branch of the U.S. company. Its activity is the U.S. company's activity, and that all gets reported on one tax return in the U.S. Still regarded corporation for German purposes. So that entity will file a German tax return. But what checking the box and treating it as a branch does, it eliminates a ton of issues. And there's no guilty calculation because all that income is already being reported in the U.S. And so it just makes life a lot simpler.
Wow. So how does that benefit the company that's in the United States because they're paying taxes within Germany, but they're electing that this is a corporation, this is a branch of their entity in the United States, and it's on their U.S. tax returns?
Correct.
So it is important to point out too that there is foreign tax credits. So and that mitigates the double taxation effect. So if you're paying tax in Germany, there are mechanisms with those elections to make sure you're utilizing those credits against your U.S. income tax on the income that's essentially getting double taxed.
Right.
So it mitigates that double taxation effect. But I do think,
is that long standing or is that only for a temporary measure of time?
That's been in place for decades.
Got it.
I do think while we're on the topic of international, though, it's important to point out that from an income tax compliance perspective, it's very punitive to miss the filings related to international compliance. So whether you're talking about a controlled foreign corporation or a foreign disregarded entity, those failure to file of those forms can carry some significant penalties per year.
Like 10K.
Yeah, 25K,
Yeah.
Per year, per form. So if you're talking about a multinational and you decide you're going to go set up 3 or 4 foreign entities for your U.S. parent co.
How many forms is that per company? Per entity?
So you'd have 4, right? One per
entity.
Yeah, one per entity.
It's just one per entity?
Yeah.
Okay.
Well, and then you likely have foreign bank accounts as well. So now you start talking about foreign bank account reporting. So now you got 2. So it can vary.
And these aren't like, we say form. It's like it's basically a tax return within the tax return, reporting the foreign activity or the activity of the foreign entity. It's purely reporting. There's no tax. The foreign tax credit calculation is probably 8 or 9 pages.
So do you guys see this a lot with tech companies that get a bunch of seed money here, but then they build development teams like either in South America or Eastern Europe or India?
Mm-hmm.
Yeah.
Absolutely. And this year particularly, it was punitive with the 174 provisions that required the capitalization of R&D. So with the Tax Cuts and Jobs Act, one of the balancing items was the requirement to capitalize research and development expenses starting in 2022.
I know. I used to love straight lining it, baby. It was nice.
Yeah.
No, it was deducting it currently.
Yeah.
I mean, you were getting the deduction today for everything you were. So for book purposes, a lot of companies had to capitalize, under GAAP, but for tax, it was like boom.
Straight line.
Yep.
Yeah.
Right at the bottom.
Right to the P&L.
Yep.
Now, not so much. And not only that, if it's domestic, you have to amortize it over 5 years. If it's international, it's 15 years.
So there's not a lot of benefit to taking it out.
It hurt this year for a lot of clients.
Yeah. Doing offshore, it's. Yeah.
But everybody wants Amazon 2-day delivery or, Prime Now in my hand. But they're mad at Amazon for ruining the R&D credits.
Have you guys seen
Get in the yang.
Have you seen the Ronnie Chang stand-up from, I think it was 2019 on Netflix?
I have not.
Oh, man. He just goes into Amazon. He's like, everybody's in America's lazy. They're just like, press a button, put it in my hand now.
Yeah. So that's why I was laughing. Because obviously they were the biggest purveyor of the R&D tax credit issue, right? But it makes sense because Amazon Web Services...
Well, yeah, they were the poster child for why it was evil, I guess. I don't know, or why Amazon was evil because they paid very little tax because of the R&D credit and the deduction.
And they basically created an industry, a huge industry. Amazon pioneered the cloud industry.
I'm pro Amazon, just for the record.
Yeah,
us too.
Yeah,
just
for sure.
Well, considering that I live in Queen Anne and I overlook South Lake Union, where
I know
Amazon
right where you're
lives.
at.
Yes.
I know right where you're at. Yeah.
So
Stop speaking about such a beautiful place.
It is amazing. Although it was rainy and kind of crappy when I left, but it was.
Welcome
nice
to
come here.
California, Patrick,
where the sun shines all the time.
All the time.
Yeah.
But no, when all the Amazon stuff came down, I read the 10K, and I'm like, everything they did was legit. They had R&D credits, and honestly, the biggest issue that saved them from paying a lot of tax was their compensation, their equity comp, because all of their employees, I don't know if you know how Amazon.
I'm actually
Enlighten
somewhat
us.
familiar. I don't need to tell
Okay.
you why, but I'm somewhat familiar.
So they basically everyone gets like $165K a year, and then everything else is in stock. And so when Amazon stock does this, all the employees comp does this, and they get a deduction for all of that. And that's what really drove their tax rate to so low, is because their stock was doing so amazing, and their people were making a ton of money. It's like, how can you beat up a company for that?
You really can't. But
this is the downside. Just like it's the
Slippery slope. Sorry.
it's looking at things with the wrong lens. I mean, Amazon employs how many thousands of people, and if people were truly getting 165 base plus whatever their amount of shares were at that time in the market, which they sold their stocks, that's good for the mass.
Yeah, I mean, we have a friend. He vested in like high 5 figures in stock just the other day with Amazon. So, it makes perfect sense. I'm right there with you guys. I think it gets back to the larger issue, which is the Ireland issue. That was probably the bigger reason why a lot of companies haven't been paying taxes. I mean, HP, they were guilty in the early 2000s. They'd go HP America, HP Mexico, HP, Costa Rica, because I think that's where they were doing it back in the day. And, every corporation has found a way to minimize the tax liability or tax issue that they have through globalization. It's, they were just, I think, the poster child for everything, because they made life so convenient for everybody to have some time to think about things they wanted to be upset about. But with that said, we'll move on to the next topic.
Slippery slope.
Yeah. Let's talk about how, as an entrepreneur, you can be proactive in no matter what stage you're in, startup or, you've got 10 or $50 million that you're operating with. What can you do to be proactive from an accounting perspective to always be ready for either that next round or that potential sell?
I think closing the financials, as quickly as possible each month, quarterly, annually, yearly is the first thing. I think it's a red flag when someone's not getting you their financial statement information until 9 months after the year end, when they're on extension and it's barely coming in. And
October 15th.
Yeah. And, there are valid reasons for that if they have, exterior investments that they're waiting on information for, et cetera. But if the fundamental information isn't there and it's not getting closed quickly, how do you manage a company when you don't know what your company did 9 months ago to be, flexible?
I also feel like, you might not be able to provide everything if you're waiting for somebody to finish theirs in the tax year, and then you're relying on their information to submit yours. But you can do so much of the legwork for you to just be ready to get their stuff, and boom, you hand it off. So just that level of preparation would also, I assume, ease the tensions you're talking about.
Oh yeah, absolutely.
Yeah, I mean, that's super advice, actually. Being able to have quarterly financials printed that can be delivered at a moment's notice, I think, is huge.
It's
segregation of duties is another one I think it's really tough in an early stage startup, because there's only probably 3 or 4 people, but actually go through the effort of, okay, you're going to be responsible for approving AP, and you're responsible for approving payroll, and you're responsible, kind of divvy those duties up, so that you at least have that feeling that, okay, we're really, taking this seriously, and you have to have the right approvals to get stuff done, and put a little bit of bureaucracy in place to manage the business.
It's completely necessary. Having read corporate bylaws myself, you're also obligated in a lot of circumstances, depending on the way yours are written, to be able to provide accurate financial information to certain people within the company upon them asking for it.
Yeah.
So that's another big one, where if you asked and you were, like, let's just say, Alan, you're CFO, I'm an exec at a company, I ask and CFO can't provide these things to me. That's a red flag.
Yeah, I'm usually have an obligation to be able to provide it, I think, within 14 days.
Yeah.
And,
to another executive.
Not to toot our own horn too much, but we do have like what we call business operations within CLA that does kind of the back office bookkeeping. And one of the things that it's kind of been fun is watching them integrate all the apps and the technology to accelerate those monthly closes. And so we do have some clients where we have a 5-day, 10-day monthly close where 5 to 10 days after the month end, the financials are rock solid.
You're looking at one of them.
Sweet.
Yeah.
That's us. Sweet.
Yeah, I think we work with your biz ops team, right?
Yes, Jerry.
Yeah, they're awesome. And, I think it's actually, we did a little company vision workshop with the founders this past weekend. And, we did this whole workshop, like, what are we doing well? What are we not doing well? What are things we need to work on? And, one of the things we were doing well is like everybody put in the financial accounting, reporting, everything else. So yeah, shout out to the biz ops team in that practice, because we're the people who close our books usually 5 to 10 days at the end of every month, or after the end of every month.
Yeah.
It is wonderful, and I know that if the first, second, or third rolls around, I'm going to be expecting a couple emails about some accounting related items.
Yeah.
It always happens.
Yeah.
Well, it's also, I mean, you mentioned kind of running a business. It's like you have to have trends. You have to be able to understand what's going on, and and getting it 6 months later, I mean, there's no time to fix anything.
There's no actionability.
Yeah.
You just realize you're in a hole from that
you're
point.
Like, all right.
And Alan, you could speak to this and jump in at any time. One of the really nice things about the way we run our operation is we're only 30 days behind. We get a look at what happened the last 30 days at the beginning of each month. So if there is a problem, we can rectify it very quickly.
Yep.
Yeah.
100%. Now, that monthly reporting package that I put together for us was largely predicated off of your guys' advice in the biz ops team. But what do you guys recommend from a monthly reporting package perspective for, let's just say, mid-sized startups?
They should, report their package monthly.
And the world
put a
goes
bow on
round.
it.
Yeah.
No, monthly reporting is I think a really good example of, and kind of going back to the beginning, the credibility piece, right?
Mm-hmm.
If an investor comes in and they're like, how do you run your business? Well, we have our monthly meetings. He's in charge of the revenue piece, expense piece. We go through our KPIs. We all understand where we are in the business. I'm going to feel a lot more comfortable writing a check to that team than just like, well, every 6 months or so, whether we need to or not. Well,
but what specifically is in that biz ops package? Because, like, for example, we have we do budgets versus actuals for the year, and then we also in ours
budget.
We go over like a cash flow statement. So what do you guys have, like a base set of reports that you would recommend to put in that reporting package?
Yeah, you want that statement of cash flows, the P&L, the balance sheet, monthly recurring revenue, probably by client. I had an interesting conversation recently with a client where they didn't realize the residuals they were getting off of their revenue stream were so high. And my immediate thought was, have you reached out to the customer, and made sure that you have a strong relationship with them and said, hey, we see that this is upticking, and we just want to say thank you, and, make sure you're spending your energy where it needs to be spent, not from an accounting or a managerial perspective, but just from running the business, making sure that you're shaking hands with the right
knowing your
people.
best clients. So, Alan, I'd like for you to talk about that. We went through an exercise of knowing your best client, largely predicated by the financial reporting work and guidance that CLA had given us.
Yep. Pretty much it was along the lines of not only who is our best customer, but who's our most profitable customer, who has the longest longevity, what are the attributes of that? And so we built and disseminated sort of democratized reporting around that to every one of our leaders in the business, so they can all log into our reporting portal and go and take a look at that and go see that and go see where their clients stack up to what our best clients are and who our best clients are and what those attributes are. So yeah, it was very helpful and very insightful, and it's been crafting the larger strategy that we have here as a business. So for us, that's what we have in our reporting package. But
it was also really nice because it gave a lot of transparency to the people that are helping us lead the business. When they get to see their eyes on that stuff for the first time, you get to see some of the other gears start spinning in their head.
Yeah.
And that was really beneficial too, because it immediately led into, well, how do we move clients from like this middle level tier to like the top tier where these are our best clients? Right. And that's really where everybody's head started thinking. And then all of these funny new things started happening where we had a lot more cross-team collaboration. We usually have it, but now it's like everybody's looking for it on a weekly basis. Yeah. So it's been really nice and healthy.
Well, and to sort of answer your question in terms of like what's in a basic package, it's going to be the financials. But I think every business has a different view that they want or need. You had a specific view about your top clients and how you want to kind of drive your lower clients into that top tier, and what activities can you do? That's going to be a discussion with your CLA team to say, this is the information we think we need. Can we get it from our financial data? And then we can build the reports and build the dashboards and do all the things to help you, achieve that information.
So let's talk about that process then a little bit. What would the entrepreneur or the business owner need to bring to you guys in terms of questions for you to help sort of set up and structure whatever their financial software is? Because you got accrual and GAAP, right? And that's, running the books. But you can also have it set up in other ways from a categorization perspective, where you can spit out reports that align more with how you see the business, less of generally accepted accounting principles. So with that said, back up to the question, what do you think they should be asking you or considering so that you guys can help them with those custom reports?
I mean, to me, it would be incumbent upon us to sit down with our client and say, all right, tell us about your business. Our CLA promise is to know you and help you. And the only way we can do that is understand your business. What are the KPIs that you're looking to achieve? What's going to help you run this business? And then it's that collaboration that will drive the outcome. So I don't know if it's as much you guys having to tell us what you want. It's this collaboration, this discussion. Hey, it'd be really great if I was able to see our sales not only by best customer, but by customer and geography, where their offices are. Okay, our financial systems may not, capture that data today. So what do we have to do to make that change?
Yeah. Right. You guys are extrapolating through discovery. What do you want the future state of your business to look like? That's an approach that we take here with some of our lines of business, where in order to learn the customer's business, there's a lot of discovery. And really, it's just working with sharp, talented individuals that ask those poking and prodding questions to facilitate the information from you to say, hey, maybe you want to consider X, Y, and Z. And then that helps answer the question. There's a lot of business specificity there.
So what I really heard you saying was call CLA. Who you gonna call? CLA. Yep. I mean, that is a really solid advice. I would say that it wasn't ever a skill that I was taught by a business mentor or something else. To be totally honest, my accounting background and skills were largely from some classes I had in college, and also my wife is a little bit of a wizard with this stuff, and then working with CLA. What resources would you guys recommend, either from CLA or out there in the world, to sort of help get entrepreneurs aware or starting to think about, keeping the financial health and reporting readiness of their business up? Is there anything that you guys have internally, webinars, podcasts outside of this, anything else like that?
Yeah, I'd say we push out content quite regularly. Patrick's name is on a fair amount of it recently, as far as producing blogs and articles that get pushed.
We have a tech blog that.
I read one of yours the other day.
What did you do?
Yeah. I get the CLA emails.
I ripped most of it off.
ChatGPT, help me.
When there's things that are like something that catches my attention, usually in the form of a large tax code change or, some general strategies, those types of things tend to get my wheels spinning. So when I have some free time, which seems to be like 2 days a month now, I usually take a peek at a couple of them.
Yeah. I mean, going back to it though, that's kind of my job, right? Is to know the client and help them and have that open conversation and to know the capabilities of CLA on the backside, right? So I kind of view myself as a quarterback. And so I have that relationship, and then whether it's biz ops, right? And you working with our biz ops team, we're also seamless on that side. And we don't do a good enough job of bragging about it, but just the other day, Jerry came over and said, hey, just want to let you know, Alan's doing this over there. I was just talking to him on the phone, blah, blah, blah. And so on our side, we're fully connected and we're communicating so that if you tell her something that sounds a little amiss and she comes and talks to me, I can call you back and say, hey, what are you doing over there?
Yeah. Excellent. And it's happened before too. So let's talk about anybody who's listening to this. They want to get in touch with you guys or CLA. How can they do that?
www.claconnect.com. That's probably the easiest way. Our email structure is firstname.lastname @claconnect.com.
Okay. So Patrick.Smith.
Correct.
Mm-hmm.
Okay. And Matt Winans. I'm not even going to remember how to spell it, but I think there's two There's an I, N, N, and another I, right?
Matt with 2 T's and then a period and then WINANS.
Oh, I had that. See, I wasn't even going to try to do it myself. I would have messed up. And then as far as LinkedIn or anything else, are you guys big on LinkedIn?
Oh, I'm a LinkedIn guru. I like the LinkedIn a lot.
Very nice. So they can just go search Patrick Smith, CLA, Matt Winans, CLA.
Top 10.
should be top 10.
Hopefully.
It's that generic last name you got there, Smith.
It's a funny story. My wife didn't want to take my last name because when we would come back into the U.S. from an overseas travel, she'd fly right through, and they're still looking for Patrick Smith. Patrick Smith, where are you?
Yeah. Well, you could always get global entry, and that would solve that problem.
Got it.
And then sort of, on some closing notes here, is there anything else that you guys want to bring up that's relevant to the conversation today that we haven't had an opportunity to chat about?
Yeah, I think we've been kind of kicking it around a little bit. Just, like I mentioned earlier, just last week, they clamped down on the ERC credit piece, but I think that speaks higher to some of the other trends we're seeing, right? Which is, you're starting to hear these social media influencers talk about tax strategies and ideas. And I heard a really funny one yesterday where somebody was saying something about how CPAs the best kept secret and CPAs don't know about qualified small business stock or something like that. And I just thought, like, really? Someone out there is listening to a social media influencer rather than the people that, went to school for 6 years to learn this stuff.
Yeah, I think that's one of the big things. When Mr. Wonderful was selling ERC credits, I knew things were going to go sideways. And so when the IRS came out and basically said, we're putting a stop to this.
Who is Mr. Wonderful?
Oh, from Shark Tank. What's his? I can't remember his name. But he was one of the original Shark Tank guys. Bald guy, always wears a black suit, black tie. Kevin O'Leary. Kevin O'Leary had a YouTube, selling ERC credits, and I'm like, that's not going to last.
No,
and it didn't. So that's the stuff. What's interesting is I watch a lot of those sort of podcasts about all of these schemes and stuff, and it's like, yeah, there's just consult an actual professional before going down a road.
And
go ahead, Matt.
And the IRS has a list on their website of the top 10 or top dozen dirty schemes that they're seeing going around, and it's kind of funny because depending on when you log into the website, they seem to prioritize it. And right now, ERC is right at the top, but conservation easements are up there.
Yeah, those have always been a
and the monetized installment sales.
Yeah, well, that didn't help with
Yellowstone,
the Yellowstone episode.
Yeah. I hear you. Yeah, totally. For those of you who haven't watched Yellowstone, I think season 5 that is. But on that note, though, about some of the changes that have come down the pike. You guys talked about the ERC, that's employee retention credits. Is there anything else from a legislation perspective with the Inflation Reduction Act or anything else that you guys want to touch on?
Yeah, you want to talk a little about R&D?
Sure, I can talk a little bit about R&D. So, so the Congress giveth and Congress taketh away. So they kind of clamped down on 174, capitalizing those costs, but they expanded the payroll offset for startup and early stage companies from $250K to $500,000. So that R&D credit, because most early stage startups aren't profitable, so a tax credit isn't going to be really helpful.
No,
if you're not paying tax. And so this payroll tax offset allows you, because these companies obviously have employees and they're paying the company's portion of payroll, that credit can offset that payroll tax. So it's actually a cash benefit today against payroll taxes paid by the company.
Up to $500,000 in annual
per
credit.
employee. Oh no, sorry, $500,000 total
per year. Per
Whoa,
year.
$500,000 in credit.
I was thinking
credit.
salary for each individual.
Wow, that's huge.
Yeah.
So basically,
and
right now,
and it carries over.
Yeah.
So if you don't have $500,000 of payroll taxes that you're responsible for, that credit can carry over.
So you're telling me that up to $500,000 in
20 years.
in payroll tax credit.
Was it 5 years for the payroll offset?
The first 5 years the company's been in existence, pre-revenue essentially, or up to the first $5 million in revenue of the company. So it really is for startup companies.
Yep.
as
Yeah,
opposed to mature companies.
They've boxed it pretty good.
Yeah, but you got to think about it like this. If you're in the Bay Area and you got a team of 20 people, which is small, okay, you're probably going to have 80% of them be engineers, right?
Mm-hmm.
They're pushing 150 on a salary, about on average. So you got 7% is California's tax on businesses, payroll tax.
Mm-hmm.
So you got
It's a federal credit, by the way.
yeah, you got let's see here,
6.2%.
10.5, let's just say $10,000 per employee, right? You got 20 of them. That's $200,000 over the course of a year that you could now be getting back cash in your pocket.
Yep.
That's pretty substantial.
It's another engineer.
Yeah, it is.
And so you're telling me that now is it's up to 5 years in business or 5 million in revenue? Was that
Yeah.
the condition?
Yeah.
Come on, why do we have to be 12 years old?
Yeah.
That sucks.
Sorry.
But that's okay. Well, that's a really great incentive for startups as
Yeah.
we're talking about, investment opportunities
Well,
and
and-
VCs.
And it's only eligible on domestic R&D. So
Yeah.
the credit is you don't get a credit for
Local
foreign.
talent.
But
Yeah.
it circles back around about, if you're that size, you should probably be working with a reputable CPA anyways, because those first 5 years pre-revenue, it's pretty important that you get that revenue number 100% right on that tax return. Because if it's off a little bit and maybe there's a misplaced credit that got picked up as revenue in 1 year, could cost you $500,000 of payroll tax credit because that starts the clock.
Yes.
Oh, I didn't think about that. That's a very good point.
Yeah, it's pretty brutal because interest will also start the clock. So interest income. So that's deemed income on your tax
Yeah, the
return.
government
Yeah.
always wants to tax us and charge us interest whenever we don't pay them. But whenever they don't pay us, it's like, oh no, here you go.
Yeah.
I want my interest on that too, please and thank you. But with that said, we covered off on the IRA changes. Any other items on the legislative front?
Well,
You said
I mean,
you
we're
said covered off on the IRA
Yeah,
changes.
Inflation Reduction Act.
yeah.
There's
Yeah.
also the
Individual retirement
Yeah,
account.
yeah.
Different topic.
Yeah.
I mean, I think there's still hope for 174 repeal.
Can you explain 174 to people?
So that's the capitalized R&D cost that we were talking about. The domestic gets amortized over 5 years and foreign gets amortized over 15. I think there were a lot of companies and a lot of clients who, when this thing happened, we said, Congress is going to fix it. Congress is going to fix it. It'll be fine. It'll be fine. Time went on, right? It's going to be fine, right? And then now we're at 10:15 and it hasn't been fixed. And so, we don't know if it's actually going to happen. There's an extenders bill that's going to be coming around. It may or may not be in there. And I know this isn't a political statement, but Congress has been focused on other things.
Yeah, I'm aware.
Disappointingly. And so this is the sort of stuff that happens and hurts businesses when they're not focused on the right things.
Yeah, we've had, I would argue, 8 years of distractions and waste of Congress's time. Right, I could 100% get behind that.
Yeah.
And so you said that it was really the major changes were the amortization schedules, 5 year and 15 years for domestic and foreign. What about visa workers? How do they count?
Where the work's happening.
It's where the work is happening.
If the work's
boots on the
happening on
ground.
U.S. soil, then it's domestic.
Yeah, it's the
Okay.
opposite of U.S. traveling to Singapore. Yeah.
Right. So if you outsourced all of your R&D to Eastern Europe, then that's going to be foreign.
But it's talking about current law. It's important to realize that the research and development credit and this 174 element has always been a political football. It's always the ninth hour pork rolling legislation that it gets
Earmarks. Yeah.
that it
Throw
gets
in.
included with. And so I think that was why a lot of the industry thought 174, it'll get rectified before 2022 hits. And it didn't. Here we are, and it didn't. And so now we're wondering, will it be a political football again or not?
This is going to happen in 24. Yeah.
Yeah, I mean, I don't know. So just to close out on that topic, because I had a client that it was like the worst case scenario for this issue. He got most of his funding from grants from DoD. So he was developing a really cool piece of equipment for training dogs. And it's got a military application. He received a grant, let's call it $300K, spent it all in R&D because that's why you got the grant. For tax purposes, the grant is income, top line. Add back your R&D expend. Now he's paying tax on the $300K.
Oh, wow.
He's paying tax on the $300K, but if he did he offshore it?
Well, it was all domestic.
Okay, so he's only getting 20% of it because he got to do it over 5 years.
Well, he's only getting 10% in year one.
Yeah, the year one's 10%.
Oh.
Yeah, because it's 5-year amortization, half year in the first year. So you only get 10% in the first year. So he's paying tax on $270,000. But he spent all the money.
So why even
Right.
file it as R&D? Why not just file it as straight line expense?
Well, because it's R&D. I mean,
Wait, but I guess this is my own ignorance speaking here. Why do you have to file for R&D credits?
so this is R&D expense. This is just you paid money to develop. It's an R&D activity.
Oh, so this is about how R&D expenses are also categorized. So you can't
Correct.
even just say R&D is now a straight, on the tax basis, it's just a straight line out the bottom of expenses. They're
No.
making you now realize, oh, wow.
And
So
so
this cat who's spent all the money on R&D because that's what his business is. But because it was a grant and it was considered income in the year that he received it, and the other sad thing is that the way his grants worked, he received another tranche just before the end of the year.
Oh, no.
So you get doubled up.
So it was a tough year. He was, the messenger took a lot of grief, but
Are they still with CLA?
yes. I mean, he gets it. I mean, it's just a crap answer.
There's so many times where a taxable event can it's just totally screw you. So not knowing how it's going to work before you spend any money, to your guys' point, like I would have much rather came out of the pocket, $10,000 to talk to somebody in the first place to offset a potential $100,000 cost.
or at least know it's coming, so you keep the a little bit of cash around for the tax and not just have to have it all spent.
Well, that's that forecasting bit.
Yeah.
Right. Yeah. Just had a good conversation with a client who's trying to forecast how much cash they need, and 174 has to come into play because it's your cash tax, right?
Yep.
So understanding the 174 piece and how much of that is going to affect what cash is left over that they can distribute to the owners. So it's very, very critical.
We had that this year unique to California too, with the California storm thing where, we got a little bit of rain. And so the federal government said, hey, you guys can file your tax returns late and not late, but it's deferred until October 15th. And so that included estimates, right? And so I had a lot of clients say, well, I'm not paying until October 15th. And I said, great, you can do that and let the money work for you, and hang on to it. But let's at least project out what you're going to owe so that when that bill comes,
you're not SHITing a brick.
Exactly.
Yeah. I am not ever the person who likes to wait. I just like to get it in and get it done.
Rip the Band-Aid off.
Rip the Band-Aid off because I like to know what I have now, what we're doing now, how we are operating. Then I could plan with that because the last thing you want to do is be like, oh yeah, I forgot that. Here's $40,000 I owe the government.
When you're playing with some more commas, right, putting the money to work is a different piece. So going through the exercise of knowing what your obligations are, putting the money to work, knowing that it's on a short time clock, and then you come out. I think just the visibility into what you should expect is the most important thing, irrespective of where you're at and using the money.
Yeah, and you kind of asked a question about other things that CLA has that can help with that. We have a wealth advisory group as well that can help companies, especially with the managing their 401k, or if they have excess cash from a raise. What do you do with that in the interim when you're planning and going to deploy, before you deploy that capital? How can that get managed in a way that is advantageous to the business?
Yeah, like we just, for example, threw a couple $100,000 in a 7-month CD, right?
Perfect.
It's not operational, and we obviously have other cash outside of that to use should you ever need it. But that's a great example of exactly that, right? It's some operational cash that was sitting there before it's getting put to use. There's a cost to having that, and it's like, why just not work a little bit of arbitrage, right?
Yeah, well, in our current interest environment, There are some pretty interesting opportunities to put that money to work.
Yeah, a little bit over 5%.
The only plus side to really what's going on.
Kind of is.
Yeah.
Kind of is. Yeah. Well, it's also, and just to put a button on the whole, tough time for raising money, higher interest rates isn't helpful, right? Because now you've got angel investors that now have, I got all this money sitting around earning 0.01% in my savings account. Yeah, maybe I'll deploy some into some risky startups, but now I'm earning 5-6%.
It's like,
the risk hurdle change.
Unless you're coming to me with
the
the
risk hurdle
teens,
change. Yeah.
Yeah, I agree. And maybe they want to sit back or have another kid or, go do something philanthropic.
It's all timing. Life is all about timing.
So, since we're talking about current developments, I think one of the things worth mentioning too is we're seeing a big uptick in our digital group, particularly because you have these startup companies, right? And they onboard with, they use QuickBooks or whatever software program they use, and then they go out and they have their CRM model and their CSL model and these other software platforms. But not all those software platforms communicate well together. And sometimes from a managerial perspective, you want to be able to communicate between them, transfer information, and we have a digital group that does that. And we've seen big strides in that lately, where whether it's the payroll piece, communicating with the accounting piece, or just extracting big data information.
What platforms are they working with,
A whole host of them.
We're pretty much a Microsoft shop. So when it comes to building the data lake and getting all of the information from all the disparate systems, I've now exhausted my entire knowledge of our technical digital group.
Threw out every big lingo he knows.
There was some machine learning and large language models and AI being done. So
Sweet.
a good example I saw was in our healthcare group. Right, we had a practice with a bunch of different doctors, and they were able to drill down on revenue by doctor, by service line, whether it was prescriptions or surgeries or what have you. And so they were able to run key financial metrics to figure out which doctors were really producing and which doctors were kind of skating by, and make some financial decisions that way. And it's pretty cool stuff.
Yeah, see, it's always interesting because we do a little bit of that work, but it's not necessarily in the finance realm. It's more in the marketing and operations realm, and also IT. But it's interesting, the times we have had the opportunity to sort of have the kimono open to us, we've been able to make some really significant strides with clients, for same reasons, which is basically how do you think about your business? And for us, it's less about, who's making your revenue, but it's more about how do your business operations align to what's making you money, right? And then how do you, narrow in and focus in on those. Same application, different domain, but extremely helpful. And that's really cool to hear. Now, do you guys do a lot of stuff with NetSuite as well, by chance?
Now we're more of a Sage Intacct group. Yeah, we have a really strong implementation team, and a great relationship with them. That and Acumatica, but primarily on the construction side of the house.
Sounds like it.
Yeah.
A couple of our construction clients are Sage, formerly Peachtree folks.
Yep.
Yeah.
So what primary practices do you guys have at CLA while we're wrapping up here?
In terms of service line or industries?
Both.
So service line, it's going to be your traditional CPA practice, right? So it's going to be tax, audit, biz ops, which is our outsourcing, back office accounting, but also a lot of accounting consulting in there. So we work with closely held businesses and their owners. We actually don't do any public company audit work. That's philosophical decision on the firm's part. We know who we are. We're a middle market firm. We're going to be $2 billion in revenue this year, but we do no public company audits because that's just a risk profile we didn't want to be a part of.
Yes.
And then digital, which is that digital transformation type group. We have folks that have the data, math engineers, and super smart people, and then wealth advisory, which is and our wealth advisory and our individual tax practice have come together to be PCS, or private client services. So for our high net worth individuals and their businesses, we can kind of provide and kind of wrap around service there. And then from an industry perspective, we've got private industries. So it's going to be manufacturing, distribution, technology, where we live, retail, professional services, ag, and
Construction.
construct. We are like the largest construction accounting firm.
That's how we got linked
Number
up
one.
with you guys through the first place.
Excellent.
Yeah.
So our older brother runs a framing company in Florida, and they're doing a decent amount, but they definitely need some back office help. So,
Are they solid? Is this solid business?
So it wasn't a joke. It wasn't framing. He used to own a framing company. It's now a concrete company.
Okay.
Both, but whatever.
Yeah.
Right.
As long as he's got a good foundation, that's all that really matters.
No pun intended.
You guys operate out of Florida or all 50 states?
Yeah, I think
36 states, 125 offices, national firm, 8th largest nationally. We launched CLA Global in July of 22. So we've probably got another 6 or 7 new firms that have joined our network globally. So
nice.
Yeah, just continued growth.
Well, Matt and Patrick, it's been an absolute pleasure to have you guys on. Thank you very much.
It's been a treat. Thank you so much.
Thank you for flying down. It has been wonderful.
It was the least I can do.
Yeah. And for those of you listening, we'll catch up next time. Thank you very much for listening.
Thank you.
Thank you. Bye.